Wake up, wake up.
From Jerusalem, Israel, this is From the Midwest to the Middle East, the podcast that explores everything new in U.S. and Israeli economy. Here's your host, Philip Stein.
Welcome back, Yair. So part one is out there, has been out there, and now we're going to talk what I proposed part two, having to do with changes that are in effect already. And I think the starting point for me is that I've gotten a lot of calls lately from people who, here's a typical call. I have a corporation. It's my privately held corporation. It did a great deal 20 years ago. I bought an apartment. It's worth so much. And my Israeli accountant said, I bought it in the corporation. And my Israeli accountant said, oh, you have a great opportunity. Just take it out of the corporation, you pay no tax, and then when you sell it, you'll only, pay tax as an individual. So we're going to do this thing, and isn't it great? And then I say, yeah, but you're a U.S. citizen. It doesn't really work. So that's sort of my lead-in for some of the good, bad, and the ugly of what Israel has come up with now for 2025 and beyond. So however you want to start, I'm listening.
So Startup Nation basically decided to innovate tax and to change the fundamental two-tier system that was used in Israel, at least since 2003, even earlier, but in its current form since 2003, which basically means that you pay tax, a corporation pays tax on its own income.
Right.
And the second level of tax is only when the corporation distributes either as dividends or as deemed dividends its income to its shareholders. And generally, if no dividends are deferred, the funds or assets remain inside the corporation, and they are only subject to one low level of tax, 23%. And the idea was, we want to have corporations in Israel to develop the economy with a lower tax rate than 50%, which is what individuals pay. But at some point, the Ministry of Finance started to believe that, and rightfully so, I would say, that people are using these corporations as a tax deferral strategy. And they basically saw the outliers, which were corporations that had like 500 million shekels of profits and were doing nothing. We're not really developing the economy in any way, and we're holding on to the money. Their owners were already privately rich enough, and they didn't need the money that's inside the corporation, and therefore tax was deferred. And what the Israeli authority did this year is that basically from January 1st, 2025, there's a huge reform that's targeting all forms of personal service companies, privately held corporations, any corporation that has at least 50% of its ownership held by 5 people or less, which is, in my experience, almost 90% of the privately held corporations in Israel. And they are all targeted and really barraged with ammunitions from all directions. So you have to take dividends every year. If you don't take dividends every year, you pay a fine. The fine is not deductible against your income. If you're a highly profitable company, if your profits are more than 25% of your income, you will need to basically pay these profits to an active shareholder. You cannot leave them in the company without paying tax. There is such a thing called a wallet company, חברת ארנק, where if you are a owner of a wallet company which gets all its income from one source, or again is highly profitable, or falls into one of the various tests that are included in the wallet company legislation, you will need to distribute all the profits every year that you earn to yourself personally and pay the highest income tax rate. And this is basically a huge change in the Israeli tax system. To the best of my knowledge, it's unprecedented worldwide. Like, there are maybe various ideas in other tax systems about this, but such a sweeping reform is unprecedented. It's supposed to bring a lot of revenue to the Israeli Ministry of Finance in this year of war. Already, initial indications show that it's more successful than what people believed. But I'm not sure what the long-term effect is going to be on the Israeli economy. That's another question, I think. But at any rate, just to get back to your question, with all of these sticks, the authorities believed that they needed to also give a carrot. And they said to people, if you have assets inside a corporation, or if you want to liquidate your corporation, if you want to get rid of it, we will allow you to do this with a minimal amount of tax. It's not tax-free. You do need to pay on the cost basis of the assets that you have, or on the amount of profits that were trapped in the corporation. But let's say you bought an apartment, 20 years ago for $200,000.
Right.
The tax you'll need to pay in Israel is only on that $200,000. You will not have to pay on the appreciation, which makes this very popular for Israelis. But then what you're saying is that doesn't work in the U.S. if the owners are U.S.
If taking your example, that $200,000 apartment is now $2 million. Okay. The U.S. says, no, you took a $2 million dividend, assuming there's earnings and profits in the corporation, and pay us tax, including, in addition to tax, Obamacare, as we are familiar with. And you won't have an offsetting Israeli credit. And then someday you'll sell that asset and Israel will cash in, right? So you'll pay a tax. So it's just a no-no for U.S. People. There probably are some exceptions if there's a great deal of losses in the company, so they wouldn't be deemed to be a distribution of earnings and profits, and you could sort of match the Israeli system. But that's absolutely correct. It's a no-no for U.S. citizens. Now, with regard to this whole, as you call the wallet corporation, Chevrat Arnak, or these new legislation, what if someone who's listening to this, mutual clients of ours, separate clients of ours, who say, well, listen, I have a real corporation. I'm the only shareholder, of me and a couple partners, and we need to keep money in the company. We plan to renovate. We intend to buy a new truck. We need to build up some working capital. Is there any provision for leaving some working capital in the company?
I'll give you an example. It used to be that for accountants and lawyers, law firms, accounting firms, advertising agencies, these service businesses, which are typically highly profitable, that these businesses were not at all included in this legislation. So if you were owner of an accounting firm and you had a great year, but you wanted to use that money to hire next year, to hire new staff, to expand, to get to new offices, you could do it. Nobody from the government was basically looking at your business plans and saying, this is approved, this isn't approved. You need to take money, you don't need to take money. So basically, as a business owner, you had autonomy to decide whether or not you were taking the money out. Following this new legislation, basically, this is kind of a one size fits all. They're saying if you have 25% profitability, you can leave it in the corporation. You don't need to take it out. But maybe 1 year you were much higher profitability. Maybe you were working on a case. I'm at a law firm. Sometimes we have cases that go 6-7 years. Sometimes you need to talk to the Israeli tax authority, and one inspector leaves, then another inspector goes to reserve duty, and you just get passed from one guy to another for years. Then after 5 years, we get paid. Suddenly, it looks like that's a highly profitable year, but we've been working on this case for a long time. Now, even if I want to take this money, which I've earned over 4 or 5 years, and I want to invest it next year, they won't allow me to do that from before tax profits. And it doesn't matter what type of business you have. You can have 50 employees. You can have 100 employees. You can be doing sales. You can be doing services. The only exemption, not the only, there are a lot of exemptions, but if you have what's called a preferred enterprise status, if you're a company that builds something and exports it, you are not subject to this law. And also banks, and public companies are also, and insurance companies, they're also exempt from this law. But kind of the small to medium businesses with a few partners, with one owner, insurance agencies, everybody is subject to this business unless you can get your profits under 25%, which is kind of a ridiculous
So
idea.
just being an accountant, I'm going to put some numbers on this. In other words, you've got three, let's make it even easier, four partners, four shareholders. They have a company, nice business, does 10 million shekel in revenue, and ends up at the year with 2 million shekel in profit. In other words, their profit margin is 20%. They could leave that 20% in there?
They can leave that 20%, but every year they need to basically distribute at least 6% of their total retained earnings earned over all the years.
So anyone who, let's say, had profits of all kinds of percentages and hasn't taken a dividend in 10 years, so they have to start taking 6% of their accumulated profits. Got it. Okay.
Right. There's a certain exemption. If you can prove that all of your profits are tied up in what's called good assets. So if you really invested in machinery, in a plant, in real estate, but real estate, not that you lease out to third parties, that you actually sit in your own offices.
Mm.
If you can demonstrate that all of your profits, or almost all of your profits, are tied up in good assets, you don't need to distribute. From my professional experience over the last 9 months, there's not a single company that could prove that. Always you reserve something. And once you reserve something, assuming it's more than 750,000 shekels.
Right.
So this firm you've been talking about that earns 2 million shekels a year in profits, if it's earned consistently 2 million shekels a year over the last 20 years, and they have 40 million shekels sitting in securities and bank accounts, even in real estate investments, but they're not for their own use, they need to take 6% of their total accumulated profits a year. Otherwise, they'll be subject to a 2%. They call it a tax. It's really a fine of 2% of their annual, not the annual, their total lifetime retained earnings that were not distributed so far.
When I was getting my MBA at the University of Michigan, they allowed me to take a few classes in law school. So I took tax in the law school, which I claim to this day I learned more about taxation in law school than I did in any of my accounting classes. And there was a tax bill in the US in 1978. It wasn't a major one, but it was enough that it got its own name. But the professor used to not refer it as the Tax Act or Revenue Act of 1978. He called it the Accountants and Lawyers Employment Act of 1978. So it sounds like this is going to give so much work to accountants and lawyers. It's because people are going to need a lot of help to resolve this. Anything else that is now in place this year that people should be aware of?
Yeah, I think that for Olim, we didn't touch on this in this part of our talk, but for Olim, this new legislation is also potentially changing the rules of the game. Because a lot of Olim, even if they were compliant and they had foreign companies, LLCs, S corps, and they use these companies and paid themselves a salary and paid tax on the salary in Israel, they were able to shield out of Israel a lot of the income going to their foreign companies. Having said that, this legislation, at least based on its language, can apply also to Olim. Nobody took the time to say this will apply to Olim or this won't apply to Olim. But if you just look at the language, there's no carve out. Usually there's a carve out for new residents, for veteran returning residents, saying this will not apply to you. This is terrible. But for 10 years, you're exempt from this legislation. I think everything here was in a hurry. So nobody took the time to ask themselves, how will this affect Olim? But if I'm someone who came to Israel 5 years ago, and I was happy-go-lucky, and maybe I didn't even come from the US, I came from South Africa or the UK, and I'm not paying any taxes on my foreign source income. Suddenly, this can change the rules of the game in the middle of the game, right? I came for 10 years based on these excellent features of the Israeli tax code that could really put me in a great situation tax-wise. And suddenly this legislation passes and nobody tells me, will this apply to me or won't this apply to me? And I can tell you that we've been waiting ever since this was legislated. The tax authorities have been promising that they will issue professional guidelines explaining how this applies to foreign residents, veteran returning residents, new Olim, and we're waiting. We keep getting these notices that it's going to come out this week, but we're already almost at the end of 2025 and still no guidance. So I think once this guidance comes out, this is going to be very interesting for people who came from the U.S.
I think another thing we didn't touch upon that I wanted to use this part two to discuss is a set of facts. New Olim or Toshav Chozer Vatik, they come, as people usually come, particularly families with small children, July, August, and they say, you know what, I still have my U.S. job, so we would say take advantage of this something called Shnat Histaglut. I think within the first 90 days of your arriving, you go online. It's about the simplest form that exists, and it's sort of called it have your cake and eat it too. You can keep your job. You're not subject to Israeli tax, even as you pointed out in part one, even if you're doing the work here, okay, because there's a provision in the treaty. But you pointed out to me that there's a trap if you do that.
Yeah.
So if you would discuss that.
Yeah, that's great that you raised that. There's a huge trap because there's a fiction that if you elect this adjustment year, the Shnat Histaglut, you will be regarded for the first year as a foreign resident. But they say at the same time that the first year that you're here will be counted, if you decide to stay, towards the 10-year exemption. So you really have 9 years. So people arrive, and then if they decide to stay, they might be in a situation where they arrived in 2025, believing that they have an exemption from reporting, which we talked about. Anybody who arrives from January 1st, 2026 will still be exempt from tax on foreign sourced income, but will no longer enjoy the exemption from reporting, which is very, very important. So someone arriving in 25, believing that they have an exemption from reporting their foreign sourced income, electing an adjustment year, suddenly will be in a situation where they are now subject to reporting because they are counted as a foreign resident for the first year, and they only become a resident of Israel in 2026. So this is a trap. We've asked the tax authorities to clarify that this should not be the case, and they refused, and they even doubled down and said, no, we're going to actually clarify that anyone who elected an adjustment year in 2025 will be subject to the new reporting requirement. So I don't think that's fair, honestly, but people need to understand that this is the situation.
Yeah, that's why we're doing what we're doing right now. So before we wrap part two up, anything else relevant that people should be aware of?
I guess that anyone with a private company, especially Israeli private company, but also possibly foreign company in a place where either has a tax treaty in Israel but has lower taxes than Israel, or doesn't have a tax treaty in Israel, they should look at their situation. And I'm not saying this as a marketing ploy. Talking to a tax lawyer, he'll always tell you have to take a good look at your situation. But really, these rules, I've been working at this for a very long time. It's hard to wrap your head around them because so many things that you believed as, definitive truth, you don't take a dividend, you don't pay tax, are no longer true. And you need to really readjust the way you're looking at your business. And there's not a lot of time left until the end of the year, right? We have the holidays, and then suddenly we're in mid-October, and that's really when things are going to become hectic.
So before we wrap up, in the U.S., there's a nice little provision with regard to trusts, that a trust that's not a revocable trust. irrevocable trust, a closed trust, what we might call, that you can decide up to 65 days after the close of the tax year to make a distribution, and it counts as if you did it by December 31st. And that, because people, sometimes till the dust settles and what the profits really were and what the needs of the beneficiaries is there anything similar in the Israeli tax system vis-a-vis like dividends, or, as you say, there's a lot of moving parts as to what the profit was. Accountants are very busy at the end of the year to get that information. What did I really make? Am I subject to this provision or not? Is there any type of period of time that after the close of the year that you can still do something and it can be considered in the previous tax year?
Well, that's a great question. I had a case early on in my career where there was a company that paid its December salary every year on December 31st because it was cash based. So they took the expense, and one year they missed and they paid it January 1st, and the Israeli tax authorities audited them and said, we don't care that every year you do it this way, and we don't care that this year you only paid 11 salaries and not 12. We're going to audit you. And like most cases in Israel, this ended in a compromise. But I would think that especially this year, people should try to do everything in real time. Okay. Sometimes there's some flexibility with accountants can do what's called pkudot nosafot, which is like you're an accountant. I don't know how to call it. I'm not one, but additional journal entries after the end of the year. But I think that can get you into trouble that you don't need to be in.
Okay. Well, Yair, thank you. And just for people, if anyone wants to reach out to you, what's your contact info, your email?
Yeah, definitely look at Yair Benjamini on LinkedIn or in our website, and it would be great to hear from anyone who has any type of question.
Great. So I wish you Shana Tova.
Tova.
And it should be a good year, not just for Benjamini and Company or Philip Stein and Associates, but for all of us. Am Yisrael, Medinat Yisrael.
Thank you. Thank you very much.
I hope you enjoyed our podcast. Feel free to visit us at www.pstein.com or look for Philip Stein and Associates on Facebook and LinkedIn.